everyone, Jason here again. I've got a great question here from the viewers today. How your property selection can impact your portfolio growth. So this is really important. So a lot of people, when they think about building the portfolio, one of the first things they start to think about is where should I be buying? What type of properties should I be buying? And these are all valid questions, but what I want you to do is take a step back. What you have to understand as a successful property investor is that you're here to invest. Property is just the vehicle that you're going to use to generate your wealth over time. In order to purchase these properties, we have to be able to be in a position to borrow. We have to be able to borrow the money because that's what we're trying to do, aren't we, as an investor? Get our hands on other people's money, be it the banks, and use that to invest in property. So in order to build a successful portfolio, we really have to understand how the finances work. We have to have a finance strategy. We have to understand your borrowing capacity, your equity position with regards to your ability to cover the deposits and stamp duties, how different property types affect the cash flows and therefore your borrowing capacity and your ability to borrow more money from the banks in the future. And obviously, how do these locations affect the cash flows on those types of properties also? So let's delve a little bit deeper. And one of the things I want to really focus on is your borrowing capacity. It's no wonder that 95% of investors out there only own one or two investment properties. And unfortunately, if that's your goal, it's not enough to achieve real financial goals. So when we talk about significant financial goals, we're talking about setting yourself up retirement, paying off the home loan a lot quicker, being able to access some significant tax credits from the government when buying these properties, helping your kids, going on more holidays. These are significant financial goals, and unfortunately owning just one or two properties isn't enough. From all of you, you really should have a short-term target of striving for at least half a dozen investment properties over time. And while that might sound daunting, if you keep watching the videos, it's not in this particular video, but other videos, I'll teach you how you can do that comfortably and do it with confidence without any impact to your lifestyle. But coming back to this strategy here about your borrowing capacity, when the banks assess what they're prepared to lend you, they're simply looking at money coming in and money coming out. That's your expenses and your liabilities. And not only are they looking at the cash flows in terms of your personal circumstances, they're looking at the cash flows on the actual properties that you're purchasing. So for example, if you don't have enough income coming in to support your expenses, obviously your borrowing capacity is going to be low. And unfortunately, that's what happens with a lot of investors. They don't have a finance strategy. They buy the wrong types of properties, and that's why 95%, a lot of the 95% of investors get stuck on one or two properties. They simply can't move forward. The banks won't lend them any more money. So let's have a closer look at this. On your screen at the moment, what you'll see is a calculator, a borrowing capacity calculator, and you can jump on our website and you can play around with this. As you can see from the fields there, the bank is simply looking at income. So one of the first things we do is put your income in there. We also put some rental income on the property, any properties that you currently own, but also put in some income on a property that you plan to buy, because the bank is assessing your ability to borrow based on the fact that you're using those funds to buy a property. So they'll take into consideration the rental income on the property you plan to borrow. So we'll put that rental income in there. Then on the expenses side, we're putting in things like your mortgages, any other investment loans that you have, any personal debt or car repayments. We're also putting in your credit card debt. So remember guys, if you've got big credit cards out there with big limits, get rid of them. You don't need them. You know, if you've got some credit cards there with credit card limit of say 40,000, the banks actually see that as an overall debt of up to 160,000 because your interest rates can be 20%. So any credit card limits that you have there, the banks will times that by 4. And then obviously, unfortunately, we get penalised a little bit for having kids when it comes to it because they cost money. But as you can see there, when we punch in the information, the calculators are not asking us how much equity we have. They're not asking us how much cash we've got. They're just looking at cash flows in and out. So once we calculate that, you can see there in that example, that particular client has a borrowing capacity of around 750,000. So what does that actually mean when it comes to your borrowing capacity? If we come back here and have a look at this diagram on the board, with a borrowing capacity of 750, what we actually want to see with our clients is that your borrowing capacity doesn't drop much below 600,000. Because if your borrowing capacity starts to drop much below 600,000, it's going to make it hard for you to buy properties. Because let's face it, you know, properties aren't cheap these days. The market's done incredibly well. You know, if you live in most of the major capital cities, you've got to spend at least 500,000 or 600,000 to get something decent. And if you want to release some equity from a property that you might already have, that borrowing capacity needs to support that equity release also. So with a borrowing capacity of around 750, moving forward, the types of properties that this client elects to purchase is going to impact their borrowing capacity. So there's three types of properties there in terms of cash flows. There's what we refer to as your negatively geared cash flow properties, your neutrally cash flow positive properties, and your cash flow positive properties. So negative cash flow is more like, for example, buying an established property in the inner suburbs of a major capital city. So over time, the property's got some good growth. Unfortunately, the rental yields haven't been able to keep up, so the rental yields are very low. And on top of that, because it's an older property, there's not as much depreciation, and therefore your tax credits might not be as high. Good property, good capital growth, but unfortunately your rental income and tax deductions don't cover all the costs of owning the property. Therefore, once you've got your tenants in, you still might have to tip in maybe $100, $150 or even $200 a week. This has a negative impact on your borrowing capacity. As you can see here, if you had a borrowing capacity of $750, the next time you run the calculator after you purchase that type of property, your borrowing capacity would reduce because you've actually purchased a liability. You've taken on an asset that's actually costing you more money, so your expenses have gone up. So these properties don't work well if you've got a low borrowing capacity, because you can see here with this client, they might be able to get one more, but if they were to get another negatively geared property, their borrowing capacity would be so low, they wouldn't be able to borrow again, and they'd end up like the 95% of investors out there. Neutrally geared properties is where you might move a little bit further away from the inner suburbs. You might target properties in the growth corridors, properties that are a little bit more affordable, properties that are newer. If the property's a bit more new, the tenants will pay a higher rental yield for it. And if it's a newer type property, you can claim all the tax deductions, so your tax credits are higher. Therefore, you're in a position where you own a property where the income and the tax deductions cover all the costs, so your financial position remains more neutral. So you don't have this significant dip in terms of your borrowing capacity. So that works very well if you've got a strong borrowing capacity, and particularly works well if you still want those capital gains. Cash flow positive properties are where you're moving a bit further away, again, from the city into the outer areas or regional areas, and typically in those areas you don't get as much capital gains, but your rental yields are high because they still increase with inflation and the CPI index. If it's a newer property, you'll get the tax deductions. So you could purchase these properties and have a little bit of cash in your pocket, but you've got to remember the opportunity cost is that you might not get those capital gains that you would get in the inner areas. Other types of properties might be properties like, for example, serviced apartments or apartments in the city, things like that. Same scenario though, you might have strong rental yields on them, but again, you probably get punished in terms of your capital gains over time. But in terms of the cash flows, this is really important. So as a general rule, if your borrowing capacity is quite low, all right, you need to target properties that are either more neutrally geared or cash flow positive. Otherwise, your borrowing capacity will drop too low and you won't be able to borrow. If you've got a very strong borrowing capacity, well then you can look at some properties that have some negative cash flows on them, because typically a lot of those types of properties tend to give you some good capital gains. But the point of this exercise is that your borrowing capacity is an indicator in terms of the type of property you should be purchasing, and you want to stay roughly above that sort of $500,000 or $600,000 so you can keep borrowing over time and buy multiple properties. All right, I'm sure that makes a lot of sense to you. We've got a lot of ebooks on this stuff. So keep learning about this. The next thing that we want to look at is your ability to cover your establishment costs. So what is your capacity to cover deposit monies, stamp duties, holding costs? Because at the end of the day, the banks are happy to lend you up to 90% of the value of the property, but you still need to kick in some of your own funds, whether it's cash that you're kicking in or equity from another property. As you can see from these two examples, in terms of these two types of properties, we've got a high cost strategy and a low cost strategy. So this is a high cost strategy. So this might, for example, an example of buying that established property in a major capital city somewhere. You might spend about $600,000. Then on top of that, you've got to put your deposits in. So on a 90% land, your costs could range between $30,000 to $40,000 because you've got to pay full stamp duties. So on established property, particularly in Victoria, very expensive, 5%. You'd pay $30,000 for stamp duties alone, and then you'd have some lender's mortgage insurance on top of that, which could be another $10,000. Then on top of that, people often buy established properties, or if they're older established properties, with the view that they add a bit of value. So you might want to update the kitchens, put some carpets in, fittings, fixtures, maybe give it a bit of a paint. So as you can see, once you tip in those funds, you could be up for around $120,000, $130,000 with your lender's mortgage insurance. So not a strategy that you might look at if that's all the funds that you have. Because if you've only got $120,000 or $130,000 to invest, why wouldn't you target a lower cost strategy? A lower cost strategy is where you might bring your purchase down purchase price down a little bit. You might target properties where you can get away with just a 10% deposit, but keep your costs down. So keep your stamp duty costs down, keep your other costs down. These type of properties tend to be, for example, buying a new 4-bedroom home in the growth corridors, or it could be a townhouse where your stamp duties are lower and you don't have all these additional costs and things like that. In this example, you might spend around that $70,000 on that property to purchase that. So the question you need to ask is that when you understand that to build a portfolio you need multiple properties over time, why would you spend 130 or 140 on this one when you can get 2 of these at 70,000? All right. So again, the type of property you choose here will impact the growth of your portfolio. Now, if you're in a situation where you've got many hundreds of thousands of dollars in cash or equity, well then you can have a closer look at these types of strategies. And remember too, the difference between the two, the high cost strategy is also very negatively geared, all right, because the rents are lower, the depreciation's lower, so it could cost $150 a week. It will bring down your borrowing capacity significantly. The low cost strategy has smaller deposits, smaller costs, and the rental yields and the tax deductions are generally high enough to cover the costs, all right? So really important exercise there. The other thing that we need to consider is your locations, all right? Because the locations will also impact the types of properties, because clients always say to me, oh, Jace, I get all this, so what I want you to do is I want you to get me either a neutrally geared property or a cash flow positive property in a high growth location. Well, it sort of doesn't work that way, all right? It's either one or the other, or it's a combination of both. So if you have a look at the map here of Melbourne, as you can see here in Melbourne, in a lot of the inner areas, we basically have some issues there with supply. All right. Now, although they're adding more and more apartments, we tend to have more competition for properties, and that's why a lot of the properties in those areas go up for auction. And what's happening is people are competing for a limited stock, and therefore they're pushing up prices. So in these inner areas, it's very hard to buy now because properties are too expensive for most investors. And typically what happens in those inner areas is, because the property's done quite well over time, the property market has increased, the properties have increased, but the rents haven't kept up with growth. So in those areas, the properties are typically very negatively geared. Now, the only way to get around that is to look at apartments. But again, you've got to be careful with apartments. Typically, you wouldn't buy in high-rises. You wouldn't buy in the city locations, because the developers and the builders can keep adding more stock. They can just keep building more high-rises. So then what we might need to look at is moving a little bit further out. So in the middle area corridors, or in the outer corridors, you've got your growth corridors. These are where all the new suburbs are going in. So this works quite well in terms of buying properties that are more affordable, buying properties where the rental yields are higher and you've got high tax deductions. So in these areas, all the new suburbs are going in, all the new homes are going in. It's very affordable, all the families are going in there, all the infrastructure is going in there. So for example, you might be able to buy a house, a brand new 4-bedroom home for $500,000, $550,000, and all your costs are covered. Now, you're still getting some growth in these locations, because as all the homes go in, eventually they can't add any more dwellings, and typically in these growth corridors you can't put up high-rises. You can only put up high-rises, you know, in the inner city locations or on major roads or intersections in the inner suburbs. So they can work quite well in terms of getting a combination of good cash flows and good growth. Then, of course, you've got your outer areas, your regional areas, all right? So some of your big ones in Victoria, or, you know, your Geelongs, which is more like a satellite city than a regional centre. And then you've got your Ballarats, your Bendigos, places like that. Geelong is doing incredibly well, but if we have a look at a smaller regional centre, say, for example, Ballarat or Bendigo, in those areas, you can buy the properties that are much more affordable, which is great. You also get very strong rental yields and tax credits if they're newer, so all your costs are covered, and often they're cash flow positive. But then the argument is, well, what sort of capital gains can I expect? Because if they don't have the same growth drivers, if they don't have the same population increases that they have in, say, for example, Melbourne, where we're expecting to see 8 million people by 2050, the question is, well, what sort of capital gains can I expect from those locations? So guys, in a nutshell, just coming back to how your property selection can impact your portfolio. Number one, your borrowing capacity. Make sure you're buying properties that are supporting your borrowing capacity in terms of the cash flows, otherwise you'll hit a brick wall of finance. When it comes to your equity position or your cash position, if you've got limited equity or limited funds, target properties where you can get away with smaller deposits, small stamp duty, smaller costs, because then you'll be able to leverage your portfolio quicker and buy more properties. When it comes to the locations, be careful again, because the locations typically have an impact on the cash flows on those properties as well. What I generally recommend to clients is target properties that are more neutrally geared. It gives you the best of both worlds. Properties that you can expect that the cash flows are strong enough, the incomes and the tax deductions are strong enough to cover the cost to protect your borrowing capacity, but also there's an expectation that there are some capital gains in those locations as well. So guys, I hope this has been helpful. Again, it's all about education. Education will give you the confidence. So to get out there, we've got plenty of ebooks on our website, we've got plenty of videos, we do lots of workshops on this stuff, so keep an eye out for that. And remember guys, you can do this, all right? There's no excuses, you can do this, but you need professional advice, so we're here to help. Thank you.